Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at 1-800-Flowers.com.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For you, we've taken a deep look into this company and, well, what emerges is a classic, high risk, high reward turnaround story.
Right.
But to appreciate that potential reward, you really have to understand the serious headwinds facing the business right now.
Okay, let's unpack this, because the headline numbers are, they're pretty tough. The market is deeply pessimistic, and for good reason. For fiscal year 2025, revenue contracted by 8.0%.
That's a big drop.
And that decline was driven by this broad weakness in consumer discretionary spending, which we've seen all over retail. But if you zoom out, the pain is even clearer.
Exactly. If you track the business over the last 3 years, revenue's down something like 24%. That kind of sustained contraction is what sets the stage for the deeply discounted valuation we see today.
Of course. People look at that trend and they just think, structural decline.
And the pessimism really hit its peak when they reported that massive net loss for the last fiscal year, around $200 million.
That's a number that grabs headlines and just scares investors away, isn't it?
It is terrifying on paper. But this is where we need to contextualize the numbers because it's foundational to the turnaround optics. That huge operational loss was heavily distorted by a colossal one-time non-cash impairment charge.
We're talking about over $138 million in write-downs. This was related to goodwill and trade name assets, mainly linked to the personalization mall business.
That's the one.
So for those who might not be familiar with the terminology, what does impairment actually mean here? And I guess, why is it a positive signal for the future?
It's essentially management saying, look, we overpaid for these assets in the past, and we are now adjusting their book value to reflect the current market reality.
It's a painful admission for sure.
But it's a financial reset.
It is. When you take a non-cash hit like that, meaning no actual cash left the building, you are cleaning up the balance sheet.
So the strategic benefit is that they are removing this future drag on their GAAP earnings. They're setting a much lower, cleaner baseline. Future year-over-year comparisons won't be weighed down by those inflated prior valuations. It signals accountability.
Precisely. They are ripping off the Band-Aid. And this bad news did continue into the most recent reported quarter, Q1 of FY 2026. They posted a loss of $53 million, which missed expectations.
Yeah, that sounds bad, but Q1, which for them is July through September, it's their least important period, right? That's the back-to-school season, not the major gifting season.
It is their weakest seasonal quarter by far. I mean, it represents only about 14% of their annual revenue. So a Q1 miss is concerning, but it's far less critical than what the market will be looking for in the coming quarter. Okay, so while the revenue story is bleak, the management team hasn't been sitting still. In fact, if we look beneath the income statement and check the fortress they built on the balance sheet, a completely different picture emerges.
Yes. This is where the investment case starts getting interesting.
So what's the story there?
This is the crucial strength underpinning the entire turnaround thesis: financial stability. Despite all the top-line issues, they have been laser-focused on liquidity and debt management. As of the end of the last fiscal year, they had paid off all revolving borrowings.
That's huge. So they are now in a debt-free revolver status. They have $46.5 million in cash and solid working capital. Why is paying down the revolver so important for a company that's trying to do a turnaround?
Because it drastically reduces the financial friction and refinancing risk. It gives the new management team immediate flexibility. They aren't spending time managing nervous creditors. They can focus entirely on investing in the digital transformation strategy.
They have the runway to execute.
Exactly. But that financial discipline is absolutely necessary because free cash flow, or FCF, was negative in FY 2025.
Right. And for listeners who are tuning in, can you just quickly explain free cash flow and why the shift from negative to positive is the lifeblood of a turnaround?
Sure. Free cash flow is the cash left over after a company pays for all its operational expenses and the capital expenditures needed to maintain its assets. If it's negative, the company is burning cash.
And if it's positive?
It's self-funding its own growth and paying down debt. Management is guiding for a powerful recovery here.
That's the critical pivot point then. Management is targeting a return to positive FCF, projecting between $45 and $55 million. That is an aggressive, optimistic target, considering they were negative just last year.
It is.
What gives them the confidence to flip the switch so quickly?
It's the operational efficiency play. They are guiding for adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization of $85 to $95 million.
So the thesis is what? That the business model can be profitable and cash generative even if revenue just flattens out.
That's it. Even if revenue only stabilizes rather than immediately reversing its decline. They are focusing on margin rebuild and operating leverage, not just volume growth.
And they are already showing results on that margin front. This isn't just talk about efficiency, they're delivering it. Early in FY 2025, gross margins expanded by 50 basis points.
Right, so 50 basis points is half a percentage point improvement. And later commentary showed those gross margins reached 38.1%, which is up significantly from the 32% they saw in prior periods of heavy discounting.
That's a huge proof point. What drove that 6 percentage point gain in gross margin?
It's a few things. Better product mix, which means selling more higher margin items like gourmet foods from Harry and David.
Okay.
Smarter pricing strategies, so they're reducing their reliance on those steep margin-destroying promotions. And finally, better inventory optimization. They are reducing waste and proving they can monetize their customer base better per sale.
So the underlying operational efficiency is already taking effect, even while the top line struggles.
That's the key takeaway.
So we have structural problems on the top line, but proven financial strength and improving margins. Let's move to the next layer of defensibility, the competitive moat. This company is clearly not just flowers anymore.
That's the entire point. Their moat is built on a diversified gifting ecosystem. They own major household names known for their quality, like Harry and David, famous for high-margin gourmet foods.
In Cheryl's Cookies, Sherry's Berries, Personalization Mall.
All of them. And this diversity is strategically vital because it smooths out the severe seasonal volatility that hits pure floral businesses.
Exactly. While Valentine's Day and Mother's Day are massive flower peaks, Harry and David is critical during the Thanksgiving and Christmas holidays.
And by aggregating these brands, they reduce their reliance on any single holiday or category. More importantly, it creates endless opportunities for cross-selling across occasions, birthdays, anniversaries, corporate gifts, holidays, all year long.
And then you have the segment that is perhaps the least understood, but maybe the most defensible, BloomNet. This is their B2B wholesale network.
Yes, BloomNet is the underlying technology and logistics backbone for thousands of local florists. This isn't just a list of florists. They provide fulfillment software, logistics integration, ordering platforms, and specialized supplies directly to these professional vendors.
So it's not just another delivery route, it's sticky infrastructure. That creates powerful switching costs for local florists, doesn't it?
Absolutely. Once a local florist integrates BloomNet software into their POS system and fulfillment process, switching to another network becomes costly and time-consuming. This B2B segment is inherently less susceptible to the e-commerce disruption that hits pure direct-to-consumer floral sales.
And it provides a recurring, high-margin revenue stream that bolsters the entire company.
It does. And they're building out this ecosystem further, too, with disciplined M&A, like the recent acquisitions of Scharfenberger for premium chocolates and Card Isle for greeting cards.
Small, strategic tuck-in acquisitions, right? Designed to capture more of the customer wallet share.
Exactly. If you're buying a gift, you often need chocolates and a card. They want to be the one-stop shop for all celebratory needs.
Okay, we've established the foundation. Financial discipline, a robust balance sheet, and a diversified moat. But here is the core bull case, the catalyst that flips the script from defense to offense.
The new C-suite talent.
And the digital transformation strategy.
This is the most material, high-conviction signal that the turnaround is real. The company signaled a profound commitment to modernization by appointing top-tier C-suite talent, specifically a new chief information officer and a new chief marketing officer.
And they were hired to overhaul the technology and customer experience. Let's focus on the CIO mandate first. Alexander Zilakowski, the new CIO, brings extensive experience from Amazon and other large tech-focused retail companies.
Right, and his mandate goes far beyond routine IT maintenance.
He's been hired to accelerate digital transformation, modernize the data architecture, and revamp cybersecurity. But the key focus here is leveraging technology for performance, specifically AI and business optimization.
Which directly addresses the biggest weakness of the company, its outdated technology stack, which struggled to scale efficiently or personalize effectively.
So let's make this tangible for the listener. What does an Amazon-level CIO using AI actually look like in the business of perishable goods and gifting?
I mean, it changes everything, from the farm to the front door. Think about perishable inventory management. AI can be used to dramatically reduce waste by predicting demand with far greater accuracy than traditional models.
Which leads to what? Dynamic pricing?
Dynamic pricing strategies that optimize profit margins based on real-time inventory levels. That means less spoilage, which directly impacts that gross margin story we just discussed.
And what about the customer experience?
That's where the CMO comes in. Melanie Babcock, the new Chief Marketing Officer, is tasked with moving marketing into what they call a full funnel flywheel. She connects the technology back to the customer.
And her mandate is deeply linked to the CIO's new data architecture, I imagine.
Absolutely. She is leveraging data and AI-driven brand architecture. This pivot is aimed squarely at the celebration's customer-centric strategy. Instead of broad, inefficient promotions, AI enables hyper-personalization.
All right, give us a concrete example of that. What is hyper-personalization in this context?
Imagine the system tracks that you purchased flowers for Mother's Day last year. Now, the system uses predictive analytics, backed by the new data architecture, to send you a personalized, multi-brand gift bundle suggestion.
So like a Harry and David gourmet basket, a specific floral arrangement, and a card-aisle greeting card.
Altogether, 2 weeks before the event, it prompts an early, higher-margin purchase and reduces their reliance on last-minute heavy discount sales. That's the revenue recovery engine they are building.
The foundation is set, the talent is in place, and the strategic blueprint is clear. But the market clearly hasn't bought into this vision yet. What does the current valuation tell us?
It tells us the market is embedding extreme, arguably irrational pessimism. The stock is trading around $4.44, down over 51% from its 52-week high. This suggests a capitulation-level valuation.
Investors have given up, and that technical drawdown sets up a potential mean reversion scenario.
It does. Now let's talk about the critical metric. Price to sales, or PS. The company trades at an incredibly low 0.2 times sales.
For the listener, what does 0.2 XPS imply?
It means the market is valuing the entire company at just 20 cents for every dollar of annual revenue they bring in. That is a deep distress valuation.
And how does that compare to the industry?
If you compare that to the industry median, which sits closer to 0.5 times sales, you see the extreme discount. The market is pricing in structural decline and possibly bankruptcy risk, which simply doesn't align with their debt-free revolver status and $46.5 million in cash.
So at this valuation, you're getting the brand recognition, the BloomNet network effect, the entire portfolio for less than a quarter of the revenue run rate. That valuation compression creates significant asymmetric upside potential if the turnaround works.
Precisely. If the company merely stabilizes revenue, and the valuation partially returns to the industry peer group, say, trading closer to a 0.35x or a 0.4x PS, that could easily push the share price into the $7 to $8 range.
So a massive 58% to 80% upside potential. This is the definition of a value play, but of course, it is contingent on flawless execution.
And we must acknowledge the structural risks that keep the bears entrenched. Structural revenue decline is the biggest one. Competition from giants like Amazon and countless niche e-commerce players is real.
And the 8% revenue contraction last year proves they are losing ground.
And then there's a crucial execution risk. The fact that the prior president had to step aside signals that the previous strategy failed. This entire investment thesis hinges on the competency and speed of the new team Zillikowski and Babcock.
That's the billion-dollar question. Can they integrate the new technology fast enough to stem the tide of revenue decline before the market runs out of patience?
We also saw a small cautionary signal with an insider sale by the BloomNet president, who sold a modest number of shares post-Q1 miss. In a turnaround story, any lack of confidence from existing leadership is a point worth noting.
It is, but that brings us to the single most important near-term catalyst that will tell us if this turnaround is gaining traction.
Which is Q2 fiscal year 2026 earnings.
Correct. We expect those results around February 2026. Why is this so critical?
Because the holiday quarter, October through December, accounts for a huge 46% of their annual revenue. This quarter is the market's first real look at the impact of the new CMO's AI-driven marketing strategies and the key period for margin recovery.
If they stabilize revenue and deliver the margin recovery they've targeted for this high-volume period, the stock could re-rate very, very quickly as the market realizes that $200 million loss was indeed just an accounting reset.
But investors need to position this properly. This is not a quick 2-month flip trade. This is a multi-quarter turnaround story, likely a 6 to 12-month horizon, contingent entirely on the execution of the digital and marketing strategy.
Patience will be required.
But the financial runway is there to give them that time.
So the key question for the investor is whether the deep discount trading at just zero point 0.2 times sales already fully prices in the risk of failure, or if the new AI and digital leadership means this category-defining brand is poised for a significant rebound into 2026.
That's a perfect way to summarize the risk-reward here. If you're looking for a follow-up topic, consider exploring how major consumer technology platforms utilize AI in personalization and logistics optimization. That will give you a perfect context for what the new CIO is trying to achieve.
Remember to subscribe and join the conversation in the comments below. We'll be back next time with another analysis.